That is sheer madness, honestly.
Let's get into it. The stock market does not reflect the economy as it is, but the economy with future expectations priced in. And according to the markets, the future looks bright. Guys, have you seen the charts these days? So let's start with sprinkling some of those facts. The S&P 500 registered a 16.3% gain, and the tech-heavy NASDAQ a whopping 43.6%, guys. That's the best annual performance since 2009. The Santa rally was capped nicely with the last-minute 900 billion stimulus package, which was agreed by Washington. Then there were January blues, with the first day back recording the biggest one-day loss since October of 1.5%. Now, stocks bubble as traders and analysts quickly digest macro events and then reflect them into future expectations of the market. That being said, markets remain buoyant and bullish, though 2021 will most likely be volatile too. The FT reported that the US valuations are stretched more so than a year ago, and that is without considering the pandemic, and it's a reaction to ultra loose monetary policy pushing reluctant investors into the market in search of returns. The issue I find with that is while the recovery and general direction is pointing upwards, as stock prices are already quite highly strong anyway, the stock markets are really sensitive to bad news, and most commentators I read over the last week are predicting one wobble in the next 12 months at least. If you do see it, be ready to sacrifice that latte and pile in. If you know, you know. There's also a lot of fuss about nothing according to the financial press. Once the news of the Georgia results have settled, generally the expectation is Biden's administration has no intention of raising taxes in the near term for fear of killing the recovery, and spending remains set to soar. The latter spending behavior is untested, so a best case type of scenario would be for the bonds to rise. So with Biden having control of Congress, that would give his administration huge scope to stimulate the economy through vast spending on infrastructure. And it's the old Keynesian approach where output is strongly influenced by the demand. Go Google it if you like. So spending yourself out of a recession is apparently the way to go, guys. The renovation to airports, roads and other transport links could cost about $3 trillion. Just a fancy fact for you. So as you know, I have an actual economist in the house. He's pretty wary of excessive public spending in a bubble. Commentators do tend to agree. All that spending and precarious support for the market also makes it feel like a bubble. I feel a little bit nervous about the whole thing. How about you guys? Let me know down there in the comments below. In any case though, the anticipated spending has sent treasury yields 1% higher, increasing the government borrowing costs. All this actually means is whether the spending will be a healthy reflation of the economy or cause inflation. So commodity prices are starting to spike. There is pent-up demand with consumers saving rates as high as the 1970s, and all this will put pressure on inflation. But what about the UK, guys? Well, the darkest hour is just before sunrise, as they say. And the UK economy is shrugging off lockdowns, with the FTSE gaining 2% in the first week and a whopping 5% in the first full week of trading in 2021. That is sheer madness, honestly. Having said that, the short-term news is dire, and it takes no genius to know that the market is pinning its hopes on an efficient vaccine rollout, which is the only way to return to normal, actually. Our government knows it, and the rhetoric is centered around doing whatever it takes now to control the spread, with harsher lockdowns expected and putting the rollout of vaccines on steroids. There's also a matter of Brexit, which is a relief. Regardless of whether the deal is good or bad, uncertainty is at least off the table, and so the glass ceiling on UK shares has been removed. The FTSE, in contrast, fell by 14.3% in 2020, the worst showing since 2008, guys. And also when you compare that to Europe, UK has been pretty abysmal. And as an example, since 2016, the German market has risen by 44%, whereas the UK has only gained 8%. It's pretty nuts when you think about it like that. British shares have been picking up. The FTSE 250 up 22% since October last year. The hype is both a combination of the vaccine and post-Brexit outlook for businesses. When you're comparing that to the US story, there is also reason for optimism and dynamism. While the global economy may be benign, British consumers have amassed huge involuntary savings, which is likely to spark a spending boom. And so it begins, hopefully, a period of new interest in UK business. Now, I've done a few videos on this topic, particularly around cheap stocks, and one very good metric to get accustomed to. So check out my videos here, and I'll see you over there.